Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day.
What the world needs now is people who see energy a little bit differently. Because seeing a more sustainable world isn't far in the future. We're building it now. GE, building a world that works.
The central government mopped up 1.41 trillion rupees as goods and services tax collection in the month of May, a dip of 16% from the record high numbers of April, but way above the FY22 average of 1.23 trillion rupees. And hours before the government made the GST numbers public on Wednesday, the auto companies had also come out with their monthly dispatch figures, reporting improved sales in May. So, do these numbers suggest that the Indian economy is finally reviving after the shock delivered by pandemic? Let's find out.
India's fourth quarter GDP data, released Monday, showed that economic growth has not come roaring back after the pandemic. It slowed down for the third consecutive quarter, growing 4.1% in the January to March period. For the full fiscal, growth came in at 8.7% provisionally after the pandemic-related contraction of 6.6% in 2020-21. While real GDP in 2021-22 is just 1.5% higher than the level in the pre-pandemic year of 2019-20, indicating that the bounce back following the pandemic has only been sufficient to make up for the contraction in the previous year. Contact-intensive industries were affected by the Omicron wave in January. Trade, hotels, transport and services related to broadcasting is the only sector that is yet to recover fully. It is still 11% below FY20 level. What emerged as another cause for concern was the 0.2% contraction in manufacturing activities in the fourth quarter from the previous year. Experts attributed the contraction to high commodity prices and supply disruptions. Private spending saw a tepid growth of 1.8% in Q4. India's FMCG market grew 6% in the January to March quarter over last year, led by double-digit price growth, according to Nielsen IQ. However, the sector's volume declined by 4.1%. The drop in consumption was more prominent in rural markets, which saw a 5.3% dip, the highest consumption slowdown in the last 3 quarters. HDFC Bank's principal economist Sakshi Gupta said the consumption recovery remains under a cloud of uncertainty for the ongoing financial year with rising inflationary pressures. However, there are several bright spots too. India's factory activity expanded at a better than expected pace last month as overall demand remained resilient despite persistently high inflation, according to S&P Global's Manufacturing Purchasing Managers Index. The PMI came in at 54.6 in May, slightly lower than April's 54.7, but above the 50 level separating growth from contraction for an 11th month, the private survey showed. RBI data showed robust credit offtake in April. Banks' non-food credit grew at 11.3%, while loans to agriculture and allied activities expanded by 10.6%. Personal loan segment continued to perform well, registering acceleration in growth to 14.7%, primarily driven by housing and vehicle loan segments. GST collection too has remained buoyant. The collection in May for the month of April grew 44% year-on-year to nearly 1.41 trillion rupees. It is down 16% from the record high collection of 1.68 trillion rupees in April, but one must note that collections in May have always been lesser than in April, which pertains to the returns for March, the closing of the financial year. Higher GST collections to an extent have been driven by high inflation, which has pushed nominal GDP growth to 19.5% in FY22. Meanwhile, in the automobile sector, global supply-side disruptions in semiconductor chips had led to declining production and increased delivery timings, impacting registrations adversely. Passenger car sales, tractor sales, and two-wheeler sales have been falling for the past several quarters. However, auto sales improved in May compared with April as supply bottlenecks eased. The country's biggest car maker, Maruti Suzuki, reported a 7.1% rise in factory dispatches, while Tata Motors' sales, including passenger and commercial vehicles, rose 3.1%. Ashok Leyland's sales spiked 12%, while Escorts' tractor sales rose marginally at 1.15% over the previous month. Bajaj Auto's domestic two-wheeler sales registered a 3% increase month-on-month.
A significant reason why the GDP number has been low, both during the quarter as well as for the year, is our net exports have been significantly negative. In that sense, if you look at just the resilience of the domestic economy, it's reasonable. Investment has grown by almost 15%. Private consumption has grown almost 8%. These are the two main things which we watch. Now, this is so far as the GDP is concerned. If you look at the other high frequency indicators, what you will see is that definitely, so in 22, we are doing much better than 21-20, even the pre-pandemic 19. But obviously, the growth is not very substantial. We are on the track of growth, but the growth numbers are not as yet extremely impressive. Consumption is something which is not doing very well. And within consumption, actually, urban consumption is doing relatively better, but rural consumption is down. And that accounts for almost 50% of the overall consumption. So at the overall level, you are not seeing too much of buoyancy. And in the fourth quarter GDP data also, we saw the consumption did not do well. And government has significantly increased capital outlay in the budget, that is public capex. So government, rather than just pushing through consumption, government is trying to do an investment-led growth recovery. Already we are seeing signs that the public capex has started picking up. Though the private capex has not picked up as yet, mainly because the consumption demand is not very strong. And there is significant amount of uncertainty. So going forward, so as I said, all the major indicators, whether you look at industrial production, you look at infrastructure index, you look at bank credit, you look at bank deposit, you look at four-wheeler sales, you look at GST collection, you see EOA, number of EOA bills, you look at electricity consumption, goods transportation by railway. And so all the high frequency data, all these indicators are suggesting that the India has come back to the growth path, and there are every possibility that the growth will gather further momentum going forward.
An 80-year-old high inflation, soaring energy and commodity prices due to the Russia-Ukraine war are threatening to squeeze the economy. Amid all this, the forecast of a good monsoon has come as a respite. A good monsoon will not only help the agriculture sector but also cool off the soaring inflation which is clouding the economy's near-term prospects. It will also boost rural demand, which in turn will help the economy recover.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
An increase in the revenue of airlines also signals economic recovery. India's largest airline, IndiGo, has reported a 29% jump in its revenue in the March quarter, but it was overshadowed by high fuel prices, pushing the low-cost carrier into losses. In an interview with Business Standard's Anish Fadnis and Arindam Majumdar, the airline CEO Ronojoy Dutta tells about the upcoming competition in the air due to the entry of Akasa and Jet Airways. He also says that the airline is going through a phase of transition and will soon become a choice on long international routes. Let's listen in.
You have been very, very bullish about the RASK getting higher and higher, that the Indian customers will be willing to pay more for a higher and for a better and efficient service. Your RASK is now at historic high. How much more scope is there to improve this further?
First, let me say that the revenue performance is very strong. Clearly, we had a large loss. But remember, the loss we were reporting was Omicron driven. I mean, now it seems like, oh, Omicron was a long time ago, but that's the quarter we were reporting. And
Right.
as you know, January, February, the Omicron was really hitting hard, and that's why we lost a lot of money. On top of that, we have fuel prices. So those were the reasons for the loss.
Right.
But the reason the market took it well was because of the revenue performance. The Indian economy is doing well, coming out of COVID. All the signs are that it'll continue to do well. And as you know, airline revenues grow at about 2.5 times the basic GDP growth. So that's the good news. Second is this intensity of travel. So, you know, as we've said many times, only 5 to 7% of Indians travel by air. And the question is, what is going to happen to that number over time? And obviously, it's only going to grow. Companies too have learned that it's probably more efficient for them to just pay for their laborers to come by air than by train, because of they lost wages and so on and so forth. And Indians too, I think we're just learning to travel more holiday trips, more sometimes going abroad, but certainly within the country. Right. So I think we're seeing that early ripple effect, and we haven't yet seen the wave effect. So yeah, there's going to be a lot more growth. So we look at the customer end to end, and we ask ourselves, our philosophy is, why would anyone make the mistake of not booking Indigo? During the booking cycle, we offer you more frequencies, we offer you more connectivity. Then during the actual operations, we offer you better reliability and hassle-free service. And then we're focusing heavily on the after-travel aspects of it. So these are all sustainable, but let me come to the cost side. So cost, as you know, $110 a barrel is tough for all airlines, but it's also getting worse and worse. April over March, fuel prices were up 11%. May over April, fuel prices were up again 6%. And May 31st, we'll get another one, and I'm prepared for another shock. It'll probably go up again some percentage. So that is sort of relentless. And then when we report our earnings, I don't think this is well recognized. You know, there was a change in the accounting just 2 years ago or so. And they said that you must recognize the total amount of foreign X liabilities you have in these leases. You have to recognize the difference caused by the change in foreign exchange. So, I mean, for us, it's a huge number. It's all below the line. It's an accounting charge. It's not a cash charge. But the headlines hit, oh, Indigo lost so much money. But that's because there's mark-to-market adjustment, which, as I said, is a non-cash cost. But anyway, setting all that aside, revenue summary is the revenue is very strong. Fuel prices are a problem. And this mark-to-market always distorts the numbers for us.
So a higher competition, a higher intensity in the market, and multiple more players vying for the same share of pie, that is not likely to have any kind of impact on
I wouldn't quite say that. But look, there was a period, and I forget when, 2013, I'm just guessing from history, that there was a strong revenue growth, right? The Indian economy was doing well, revenue was growing, but the airlines still managed to lose money. Some people went out of business. What happened? Well, all that revenue growth, you can either take it in volume, or you can take it in yield, or you can take it in a mix of the two. Unfortunately, at that time, everyone took it in volume. Now, you can't be losing on every passenger and saying, I'll make it up in volume. That just doesn't work. So that was a mistake that the industry made. I'm hoping we are now again in another strong revenue upcycle. And I'm hoping the industry will have the foresight and the wisdom and the maturity to take it as a mix of volume and yield rather than all in volume. Now, I'm optimistic because so far the industry is behaving well. You know, whether it's Air India or Go Air or Spice, we all seem to be behaving in a very mature. So that's why I'm hopeful. But that's not to say there won't be pressure. Of course, there'll be a pressure. We just need to handle it in a mature and sort of it's a balancing act.
You are looking at 55 to 60% increase in ASKs in FY23. So where would we see more? I mean, would we see Indigo ramping up frequencies on existing routes, or will we see more new stations coming up?
The 55% growth was over 2022. which had the Omicron COVID effects. I think that's why I keep going back to pre-COVID. How do they compare to pre-COVID? Compared to pre-COVID, our capacity will be up about 15%.
15.
Yeah. So yeah, which is still a good number. And then as we go further another year out, we'll probably be back at 20%. But for this coming year, pre-COVID, we're looking at 20% growth. But sorry, 15% growth.
15.
So we'll keep looking for new stations, and new stations are doing great, so we won't stop. International is where I'd like to see more growth. Now, having said that, we're still growing internationally. We're adding Bahrain, we're adding Ras Al Khaimah from our pre-COVID levels. But total is still down because of Sri Lanka and China and places like that.
Is there again some thought about getting wide body planes, or is it still?
And the answer is, if we get these things aligned, if in fact we get the MCTs and the banks alignment and the connectivity we're looking for, it's only a matter of time before we do wide bodies. As you know, we're going into Europe in a big way as soon as the XLR comes in. That'll be our first foray, but it will not only go west with the XLRs, we'll go east with the XLRs as well, to places like Manila, Seoul, and so forth. So once we get that connectivity going, it's only a natural progression to get into the wide bodies.
Thank you,
Thank
sir.
you, guys.
Thank you so much, sir. Thank you so much.
Thank you so much.
क्या हाल?
मत पूछ यार,
फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The Indian aviation sector is facing cost pressure due to rising crude oil prices, weaker rupee and sticky inflation. And with Akasa Air and Jet Airways taking to the skies in the coming months, the heated competition doesn't bode well for listed players like IndiGo and SpiceJet. Our next report captures what the intensifying competition amid soaring fuel costs mean for incumbent players and what should investors do. Interglobe Aviation and SpiceJet have had a hard landing on the bourses so far this calendar year. Shares of Indigo Airlines have tumbled 10% on a year-to-date basis, while those of SpiceJet have crashed 30%. In comparison, the benchmark S&P BSE Sensex has slipped 5% and the BSE Mid-Cap Index 7.4% and the Small Cap Index 10% during the period. However, analysts don't see clear skies for the two players going forward. Rising crude oil prices and entry of Akasa Air and Jet Airways cast a spell on their prospects.
See, we believe with new entrant, the competition is going to intensify in the airline sector as the new players would definitely try to make their mark in the fast-growing aviation sector. And if we talk about the demand scenario, it has improved significantly. It's almost 70% of the pre-COVID level. So the long-term growth story definitely remains intact, but with the new players now, there is a possibility of price war, and it will be more on the price correction instead of rising the fares. And this situation wherein we are seeing crude hovering around $120 per barrel. So it's not an ideal situation for the airline sectors to go for such kind of competition, so as that would impact their margins.
Brent crude is testing $123 per barrel mark in the international markets after staying range-bound within $105 to $110 per barrel for the better part of May. According to analysts, airlines have historically revised airfares based on the supply situation. Thus, an upward revision in fares, if any, may be sometime away. But there are caveats.
So yeah, they're not going to absorb the cost because the last parking aircraft and storing aircraft over the last 2 years throughout the lockdown, that cost has been quite severe, and airlines haven't really recovered that cost. So they're not going to absorb this at all. I mean, they'll pass it on to the traveler, and the traveler will have to pay for it. The cost of fuel is going to rise up. The cost of insurance is going up. In fact, flying to Europe is going to be more expensive because you'll be flying over a conflict zone, right? And because you're flying over a conflict zone, you'll end up paying something called WRI, or War Risk Insurance. So the cost impact is going to be quite significant. It's going to be significant. That'll raise airline passenger tickets by at least 25%.
Meanwhile, Rakesh Jhunjhunwala-backed Akasa Air is mulling the launch of its commercial operations by July. Jet Airways Air Operator Certificate 2 was revalidated by the Aviation Regulator Directorate General of Civil Aviation in May. With these developments playing out, Ansuman Deb of ICICI Securities believes the road ahead for incumbents will be to keep maximizing yields and try keeping costs low. Some of the cost savings, including cut in salaries, will reverse now, which will push up expenses further. However, route-specific innovations will be critical from here on. Against this backdrop, here's what lies ahead for investors.
Airlines historically have proven that they are not long-term investor stocks which have created wealth, but favorite for traders. Looking at the current situation, there is a sentimental bias towards airlines, where the post-COVID opening up story has played out extremely well, as both business and leisure travel have boomed. However, crude, I think, has played a spoilsport, though the fares are higher and capacity utilization has improved considerably. The margins are still faltering. Now, with two more players in the fray, Akasa starting possibly in July and Jet Airways maybe 2-3 months later, competition is clearly hotting up, especially when the peak season is getting over. And it would be a great time for customers, as discounts will be high and so many more seats in the market. And unless crude really corrects sharply, airlines will still struggle to remain in the green. So I think it's a good time for flyers, but surely not for investors.
Surely airlines are in the soup as soaring fuel costs bite into their profits, while increasing competition dents prospects of fare hikes. The near-term outlook, therefore, remains under pressure. Meanwhile, Thursday's trading session could be marked by volatility as investors will adjust their positions ahead of the weekly F&O expiry. That apart, stock-specific action and global cues will dictate the market trend.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The crude oil is on the boil again after the European Union's decision to ban its import from Russia in a phased manner. And as the burden on the government exchequer and people's pocket is increasing, some experts are suggesting a temporary tax on oil and gas companies which have profited from the price rise. It is called a one-time windfall tax. Our next report tells more about it.
Russia's attack on Ukraine has upset the supply chain, pushing world inflation to uncomfortable levels. And one of the reasons for soaring inflation is the steep rise in crude oil prices. But as the government exchequers are bleeding, oil and gas companies around the world are minting money, whether upstream, midstream or downstream. These gains are not coming because of any improvement in their processes, but because of the geopolitical situation. Crude oil prices are now hovering close to $120 a barrel. On Wednesday, it was $118 a barrel. With governments and central banks taking steps to curb inflation, the talk of taxing companies gaining from the crude price rise is gaining steam. Such proposals have been discussed and even imposed earlier in many countries. Last week, the United Kingdom announced a 25% levy on energy companies to ease the financial burden on households. Some other countries like Italy and Hungary have also imposed this tax. A top government official told Business Standard on condition of anonymity that while theoretically a windfall tax on oil companies can be imposed in India, there had been no discussions on it within the current dispensation. On Monday, responding to speculation of windfall tax, state-owned companies Oil India and Oil and Natural Gas Corporation, which is ONGC, said they had not heard anything from the government. And if a windfall tax is imposed in India, it will not only be levied on private players like Reliance but also on state-owned behemoths. This means the latter may have to compromise on dividends and share buybacks, both of which the centre is a beneficiary of. The centre could do with additional resources mobilization as it faces a growing expenditure burden and a hit on revenue in FY23. The FY23 fertilizer subsidy budget estimate is 1.05 trillion rupees.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Chairperson and Managing Director of state-owned ONGC has said earlier this week that the company is planning to spend 30,000 crore rupees on capex in 2022-23 and it does not expect windfall tax. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.